All right, thank you everyone for joining us today for the Virtual Vision Finance Understanding Traders COVID-19 Edition. I'm here with our esteemed panel of speakers, and my name is Steven Itzakis. I'll be moderating this panel. Again, our speakers are here to provide you with insight regarding ways that traders have been dealing with the market conditions since the start of the pandemic. So on that note, before I introduce our speakers, before they introduce themselves, I wanted to let you know that you could submit comments here and we'll be taking questions afterwards as well. So thanks again for joining us from no matter where you are in the world, as well as for our speakers who are here from different parts of the world today. So let's dive right in. For our speakers, please briefly introduce yourself and share what about your positions allows you to know about traders' behavior. And we could start with Anne.
Great. Thanks, Steve. So my name is Anne Hunt. I'm the CEO of Chasing Returns. We're an Irish headquartered company, and we partner with large brokers to provide both behavioral analytics in terms of helping traders figure out their strengths and weaknesses and try and act on those. And we also recently launched a risk console called Playmaker, which allows traders to track and monitor against their own plans. So we're coming to this, I guess, the biggest period of high volatility that we've seen since the company was formed about 5 years ago. So we've had a really interesting couple of months just examining what happens to beginners, what happens to experienced traders, different types of styles of trading, and how our different traders have reacted. So I'll be able to talk a little bit about some of our insights there.
I'm sure we all look forward to hearing you. Okay, Eugene, can you go next and give us some background?
Yeah, thank you, Stephen. Excuse me, Eugene Sorensen. I'm the Chief Product Officer here at ChartIQ. ChartIQ is, we provide infrastructure tools, development tools for actual vendors. And also banks and brokers use our tools. So our experience really is one step removed from the trader, but we get a broad spectrum of vision from speaking to all of our different clients and the challenges that they're having or the opportunities that they see. And that ranges the spectrum from Bitcoin to equities, really commodities, etc. Right? Quick introduction of myself is I started my career in the seat of many of our viewers today as an analyst and trader. I then, about 20 years ago, moved into financial software. First with a group called CQG in the technical analysis space. That's always sort of been my core focus. And then on to Cantor and Bloomberg, where I oversaw the graphics on the terminal. And now here at ChartIQ, with, as I said, the opportunity to build new tools and address the needs of today's traders.
Excellent. And Nima or Jerome, since we were keeping it in alphabetical pretty much order.
So I'll go. Hello, everybody. Pleasure to meet you for this virtual expo. So my name is Jerome Favres. I'm the Managing Director of Trading Central Labs, which is a fintech powerhouse that works on building new investment tools using AI, machine learning, and NLP. We cover whole range of asset classes, all types of product suites, fundamental, technical, sentiments. And as for myself, before I created Trading Central Labs, I was 20 years on trading floors for houses like Barclays, Deutsche Bank, SocGen, doing equity link strategy for these banks. So I do have a bit of knowledge with those funky guys known as traders.
Excellent. And Nima, if you could take us away.
You got it. Nice to see you again, Stephen and well. Eugene, Jerome. Pleasure to meet you guys. My name is Nima CR, Chief Sales Officer for the FX Primus Group. I've been working in the Forex industry for about 12 years, with about 20 years in the financial service industry based in Southern California. I'm based in our headquarters now in Limassol, Cyprus, but essentially I overlook the global sales operations for the company. We operate 6 offices globally, and I feel that my insights from, let's say, the retail broker perspective might bring some additional insights from being on the front line, per se. So I'm looking forward to hearing your feedback and input and sharing some tidbits of myself as well.
Excellent. So without further ado, I mean, the main question that, is on the mind of, I think, everyone here and all the traders and investors is, over the past couple of months, I would say since February, the markets have been so turbulent. There's been so much volatility, so much uncertainty with the COVID-19, pandemic globally. What would you all say is the most significant changes that you've spotted, from market participants and investors between, say, February and now? And feel free, whoever wants to start this off.
Well, I'll go ahead and jump in. Certainly, what we've been hearing from our clients is massive volume increases, of course, but principally in the equity space. Equities and commodities, less so than the FX and Bitcoin space. Really, it seems people are attracted to volatility. That's where they see opportunity, and so that's really drawn them into looking at those markets and trying to understand the market depth, what's going on, where the opportunities are. Obviously, we've also seen a big divergence in industries, right, in sectors. So looking at sector analysis and trying to understand which markets or which companies and which sectors are trending up or versus down, right? Because obviously we've seen some big winners and we've seen some big losers. So
right.
That's
a great point, with some businesses doing really well during the pandemic. And I guess that leads into our subsequent talking points, but is there anyone else that would like to add on this particular topic? Because I'm sure you're all in agreement with Eugene's views, but there might be other perspectives as well that anyone might like to add.
Yeah, Stephen, just to jump in, I would say from a retail perspective, and in the time having worked in, let's say, the retail space, I've been around some big, let's say, movements, Brexit aside from, the Swiss National Bank dropping the peg, et cetera, some big movements. And what I really noticed from February up until now, I've seen an increase in the amount of our total traders. So let's say month over month, I'm seeing a lot more traders. But one interesting dynamic is I'm seeing the average volume per trader is a little lower. Obviously, the volumes are much higher, as Eugene was saying, than we've seen in many months. But I'm finding that the average volume per trader is actually decreased. And I don't have a specific understanding why, but if I were to make an estimation, I think it might have to do with more of the risk appetites there, but maybe the being more cautious with their funds and their equity is there as well. Maybe income streams aren't consistent, et cetera, et cetera. So I'm seeing the average volume per trader decrease. Another dynamic that I find quite interesting is that a few of our clients or regions that we have big markets in Latin America, specifically, let's say like Brazil or Turkey and South Africa, where their, let's say, bank accounts are in the exotic currency and they've converted their accounts for a USD-based currency trading account. A lot of them have withdrawn funds in order to just get that currency disparity, more or less a carry trade, unanticipated carry trade, let's say. So these are probably the two largest observations that I've taken away from these times, but surely very exciting to say the least.
Interesting. So I guess traders are being more cautious, position sizing more conservatively. That makes sense. Jerome, what's your take on the way that traders have been responding during the pandemic?
I will echo what Eugene and Nima said here. It was quite interesting period, just like all the crises actually. But we saw obviously a very dramatic change in the way people and traders are looking at markets, and especially the equity markets. Before we were like in a growth market. Looks like value is back there. People are more looking in depth in terms of analysis. What is quite significantly as well is the volume of news and information people are eager to look at. We saw that huge volume published blogs, IDs in the market. people expressing their fear or sharing their ideas and so on and so forth, which is very true for retail. It's a little bit similar for the professional traders. They were a bit lost. No crises are the same. And it appears as a flash crash at the beginning, and it turns very differently now. So it's a very interesting period. Lots of changes, especially as Eugene said, on the equity space, where a market is really changing completely.
Right, right. Yeah, it's a different, I guess, kind of crisis that we have now compared to the flash crash or the last financial crisis, which kind of tapered off more slowly. This one was pretty abrupt in March. And what are your views on the past couple of months and the traders' reaction to dealing with all this volatility?
We have some really interesting insights. We looked at the behavior of beginning traders. So one of our studies, we looked at traders who were effectively beginners in January and February when things were nice and quiet versus traders who were beginners in March and April. So we saw the most exuberance in beginners in March and April. Compared, the number of transactions per day were probably almost double. But I agree with Nima, the position sizes weren't bigger, but the volume of trading was bigger. When with our more experienced traders, they tended to be very much dependent on their style of trading. So kind of the trend following traders really didn't change very much, but the scalping style of trading, there was huge volume. So overall, our volumes were a lot higher, but it really came down to your style and your experience.
Right. That's interesting. So the beginners were a little bit more active than they otherwise normally would have been.
Yeah.
And I can imagine this is probably because they were all so focused on the news. As Jerome mentioned earlier, there's so much content that we've all been exposed to in the past couple of months. With the pandemic, whether it's vaccine news or cases, it seems like news is driving the markets more than ever. And that's a question that I want to touch on later with regards to fundamental and technical analysis. My next question is, what are the changes that you're seeing in terms of how traders are actually consuming news and research, whether it comes to looking for new trading opportunities? Historically in Forex, they're either using technical analysis, looking at trend lines, or following governmental announcements, whether it's non-farm payroll, producer price index, unemployment, etc. I feel like that might have changed a little bit during the pandemic. What's your take as content providers, as well as charting software providers? Are brokers missing out on something here, or how have traders approached the consumption of news during this time?
Well, go ahead, Tro.
I can take about it because we recently launched a product called Buzz, which is a new way of tackling the information overload, the infobesity, like we would say, because there's too much information and it's very difficult to consume and take informed and efficient decisions. So news is the way people are consuming is simple as you have a feed and you read the feed of news from your most preferred sources and you try to find your solutions. What we provided with our solution here is our ability to mix AI, machine learning, and NLP, and help the investor by telling him with a visual concept what stands out, what's buzzing in terms of news, because sometimes there are some elements they don't necessarily see or with their usual feed, and that's where it's kind of interesting because that provides more information. You can digest more. The machine does it for yourself because at this level we are talking about digesting millions of articles by the day. So you can provide.
I'm sorry. What was that product called that you said you guys just launched?
Trading Central Market Buzz.
Market Buzz. Okay, so it like cuts through the noise of all the information.
Absolutely, and we integrated, for instance, with the Eugene platform, Chart IQ.
Excellent.
And what is kind of interesting as well, beyond the ability to cut through the noise and provide insight, is also being able to decipher the psychology of the crowd, because with the machine, the AI, you are able to quantify the positiveness or negativeness within the news, and you aggregate for everything, that gives you a sentiment on any asset possible. And sentiment is a great alternative to fundamental or technical, that in markets like this are kind of off. The fundamental is clearly off there.
Right.
A sentiment will give you some sort of timing element. So you might have an idea, but if the crowd, the market is against you, you might want to step aside for a minute before deploying your position. So
right.
So that's where we believe the news are consumed in a different way and in a more advanced solution. Okay.
Interesting. I think that's a great answer to the question, because it sounds to me like usually fundamental news would be more important, or technical analysis. And now, because those have kind of lost a little bit of their weight, there's more focus on the sentiment, the expectations. And it's like the markets are sort of an indication of not of fundamentals anymore, but really of just the market sentiment more than ever. And not to say that sentiment wasn't valued beforehand, but it seems like it's more now. Sorry, Eugene.
Yeah, I fully concur, but I think it also plays to what both Ann and Nima were saying is there's, Nima saying we have a growth in the number of traders, and Ann is seeing a lot of early traders, enthusiastic traders, right? I think those are traders who also look to news, right? There's people who are at home, right? They don't have as much to do. They're following the news. It's obviously a crisis that's in front of us. We're all looking at it. So, and they don't have the same knowledge of doing fundamental analysis or doing technical analysis. That requires a deeper study into the markets. Newer traders are going to be driven and think about news. I think tools like TC Buzz that are doing sentiment analysis, Rave Impact, Market Early Bird, are great analytical solutions that pull news together or social information together that are driving, just as I was mentioning before, around sectors, right? It's from the news that you're going to be able to learn, what's going on in shipping, right? There's not too much information from the fundamental side, right? Unless you're looking at alternative data, and essentially that's what Jerome is producing, is alternative data. There's other sources of alternative data, but it's really being able to bring all those different content sets together so that you can really tell a complete story and blend that content together, as Jerome was saying, putting that, the time series analysis of your sentiment together with your price analysis. That's what's really going to be able to drive it. And then as you can lay in other information, you'll really be able to get a full story and make an intelligent trading decision.
Excellent. Yeah, that's those are great points with regards to finding trading opportunities, which is really kind of what it's all about. For traders navigating these markets, they're like, where should I invest my money? What should I trade? There's so much volatility. But as you mentioned, certain sectors might be doing a lot better than others, as we've seen. And you mentioned earlier about the shift, the focus on stocks and commodities, and kind of, FX didn't get as much of the volatility, although I'm sure, volumes were higher on the FX side as well. What are your thoughts on the intense focus on equities, on stocks, on commodities? where FX kind of was in the background and not as much as a focus? You know, were the quantitative easing packages to blame? The fact that all the central banks kind of acted in unison? I mean, we saw a huge, sell-off with the dollar strengthening in March, but then kind of like a V-shaped recovery. So, why weren't FX markets as lucrative? I mean, there's been obviously a lot of volume, but what are your thoughts about the volumes? And, did you see traders moving to stocks that were previously FX only, or a greater shift over from, the CFD traders to equities and away from Forex? Perhaps Nima, you could share some views, from the brokerage side.
Sure. Well, even to reiterate what Eugene had said, we did see actually a big shift with more people trading equities. And I think in most cases, as Eugene said, a lot of people are at home, they have access to news, maybe not as much to do, et cetera. But we did see a huge shift, or I guess I wouldn't call it a crossover, but a big movement of users going from FX, or at least diversifying their portfolios into equities. And I would imagine could be possibly just, the paradigm of, investing in equities is a little more safer and less risky than, let's say, the traditional Forex product. So, we did see a big uptick, for airline stocks, big pharma, et cetera. But obviously with a platform like ours, it's purely CFD. So we had a lot of people trading and speculating that these products were actually going to decrease in value as opposed to long-term strengthening. But, being that we are a pure STP broker, we seeing all these high volumes, et cetera, and seeing our traders diversify their portfolios, et cetera, was very exciting to see. But a lot of people, because, technical analysis to a certain extent is not as valid as it once was, particularly in specific products like oil, for example, and the fundamental analysis in most cases was having very little impact on the movement. So it was going to, market sentiment, and I was finding that a lot of traders were making not unmethodical decisions, risky decisions, more or less gambling, not so much trading. So it was slightly concerning to see, but definitely I did see many traders diversifying their portfolio, moving into gold, a lot of people trading gold, and definitely into the equities as well.
Yeah, just one point as well, we shouldn't also forget that with the COVID, the crisis build-up, we also had this massive drop in the oil prices that completely changed the landscape of investment. So that's definitely also a big element that has created this airdrop in the market, and that was quite significant for commodities and for stocks, just like you said, for some sectors that were massively hammered there and that are still struggling quite significantly.
Right. Yes. The extreme volatility and price drop in oil, and I've spoken to investors as well that tried to diversify. Which leads me into my next question, but Anne, before I go into that, is there anything you wanted to add with regards to, the last question of just watching traders, shift or trade equity for the first time in CFDs? Like Nima said, maybe it was the ability to short certain equities using CFDs as opposed to, trading actual stocks where you can only maybe buy an option contract to go short, or, because it might be harder to borrow the stock from an online broker, or using a leveraged ETF that's short. Did you see a lot of beginner traders go straight into equities as opposed to Forex, or any crossover?
Forex at the minute. So most of our traders would have been starting and staying in the Forex markets. We have a lot of education that comes with our software, and one of the things we tell all beginners very early on is that if you can stick to 5 products or less, you're way more likely to be successful than the trading anything that's moving kind of thing. So we have a lot of positive nudging around, don't be moving around across all the markets, and actually it's clearly working, because we didn't really see a lot of switching. And the places we did, so the trend type traders, right, they did the best. Whereas the scalpers, or there was a lot of gambling. There was a lot of, as Nima said, sentiment is here, let me in, let me out kind of stuff. And even our successful winning traders still did well scalping, but they didn't do as well in March, April as they did January, February. So we saw that behavior very strongly, but I don't have a strong analysis across the different asset classes.
I would add for a moment that I would think that the FX markets and this strong trends that will come in the FX markets coming out of this, right? As we begin to see countries open up and we begin to see the impact, the economic impact, which is going to differ significantly around the world, we're going to see different fiscal policies executed. We already have, right? Europe's behaved very differently just because of the whole structure of the economy and the social network support system there than the United States. That's going to have long-term ripple effects in the FX market because that's what's going to change those underlying fundamentals in the market. So I would think that the FX space will be really interesting coming out of this as the equity market begins to calm. I wouldn't want to venture as to when, but I think that will happen.
Yeah, hopefully those trends are going to be lasting. So traders can take advantage of them and feel more confident, at least, about their trading. And I wanted to add on my earlier question with regards to trading during volatility, whether it's stocks, whether it's FX, commodities, crypto. When the markets are volatile like this, the ability to use whether it's a stop loss order or limit orders, are you noticing clients leverage different order types to a larger degree, for fear of either getting a margin call just because of the crazy moves that have happened, to protect their account and to manage their risk differently? Has there been any changes to the trader psychology from that perspective?
Terms of the mechanisms of trading, but we certainly have seen with our traders that our winning traders did way better in March and April than they normally do. Our losing traders stayed about the same, so that's really positive. They didn't lose more money. Their expectancies were very kind of similar, but they were trading a lot more, but they were trading smaller, but yet they had bigger outliers. So clearly, and we have a discipline score we give to traders, and the discipline score, a part of a factor of that would be going over the stop loss you've set for yourself. So you dynamically allocate your capital for the day, and maybe you set it to 2%, whatever. We saw more people break that. So it would suggest that possibly people were still not thinking clearly in terms of their risk parameters and the increase in volatility. So we did see a little bit of that. But overall, because we had the ability to track people and nudge them back to good behavior, thankfully we didn't have huge losses. But there was certainly much more undisciplined behavior going around for the last couple of months.
Right. Excellent. Well, it's interesting at least to hear that, they didn't just make money on one big trade, even though there were those outliers. They were, doing a lot of turnover with smaller positions, and even if they deviated from their strategy. Eugene, are there specific tools that you've seen that have been either more effective or more popular during these times when it comes to charting and technical analysis and moving average? I mean, traders are very passionate about technical analysis and the hundreds of indicators out there that exist. What trends have you seen within your software or within the greater market on the technical side during this time?
I think a couple, right? So first is, I think it's really important for traders to be understanding that they need to use different tools during trending markets versus volatile markets or topping or bottoming markets, right? Those are very different kinds of conditions, and you need different trading tools and strategies to execute properly in those environments, right? And so like specifically, you need more tools that provide, from a technical point of view, unbounded ranges, right? Something that's bounded like an RSI or a stochastic just tends to limit in a move like this, whereas tools like MACDs and Bollinger Bands work very effectively in volatile markets. So that's one thing that we've certainly seen. The other thing, and I'd be actually put the question to the panel if they have insight on it, is the activity in options. You mentioned that. We're definitely seeing a strong interest in options, and I think that's also true in the broker community, right? The changes in the underlying dynamics of the market, which I think is also affecting some of the introduction of new traders, right? The fact that we've gone to fractional trading, the fact that we have now gone to zero commissions, right? It's really interesting that those are two things that happened, sort of in the 6 months prior to the COVID. So they really sort of opened the door to a lot more traders and to people coming in, right? If I can trade for free, well, that's really helpful, right? It reduces the market friction, right? And so I think it's, and as I say, fractional trading allows me to participate in big name stocks that I wouldn't otherwise get to because I don't have the capital, right? So I think that's been the other magnet that's helped draw people to equities. And I think, as you said earlier, right, it's something that people know, it's that they get, it's the names they're seeing in the news, airlines, oh my God, what an awful space to be in right now. But Zoom, here we are, there's a good place to be, right?
Right.
So
it goes back to your sector point earlier. So,
yeah.
Very, very valid points there. And thanks for that feedback. I'm sure it's going to be valuable to our listeners. And on that note, perhaps Jerome or anyone open to this question, with regards to trading signals, obviously, whether it's, some newsletter, whether it's an analyst recommendation, whether it's a chart pattern, a systems developer that's running some algo, what have you observed, I guess, in the past couple of months? Typically, like, algos are known to kind of go haywire during extreme market conditions. Is there a set of maybe patterns or algos that performed better than the usual? And perhaps that could tie back to what Eugene mentioned, where certain technical indicators were less constrained versus others. Did you observe any, more successful than usual, or did you see the shift go more towards the sentiment side, like you mentioned earlier, where the sentiment kind of got more of the weight than the other fundamentals or technicals?
That's a great question. Thank you for asking me, and it's a very tricky one.
Right. No easy answer.
For sure. A crisis like this one, or 2008, or any other crisis, works in sequence. And the beginning is usually where the market drops dramatically, and you're like, okay, nothing works. So like nobody knows exactly what to use. A fundamental, you can't necessarily use it. Analysts, they don't necessarily know either where you are. I've been one, so sometimes I was like, don't know what to do. Buy some options to protect your portfolio. That's the safest place. Yes, we will tend to go and look at technical analysis, because technical analysis, you use indicators that helps you understand what happened in the past, and you expect that it will happen again. That would be the pattern system. The algorithm, when you are talking about the algorithm messes up, yes, because when there's a crash, they have those limits and they tend to mess the market up. But let's not forget, the algorithm is written by a human who might have some different set of boundaries in terms of risk, in terms of issues and some types of crisis. So algorithms don't necessarily help you there as well. So the first sequence of a crisis, you never know what's going on. You don't know where you should turn yourself in terms of finding the right indicator. And that's where actually, as a former professional, I found some very interesting ways in the market sentiment, because it's a good proxy of where we stand. And beyond the sentiment, which is positive or negative, now you are able, not necessarily available for the retail market, but you are able to extract emotions out of tweet, blogs, or whatever. Emotions like fear, like joy, and being able to quantify elements like fear is a great way also to see if the market participants are in a specific mood, and which means that you are at the beginning of the cycle, the down cycle, or at the end of it. It's an element that you won't find, for instance, with volatility indicators like skew or time structure, because there's always remanence element there. But the sentiment is a great nowcasting tool to have a snapshot of what the market participants feel about a country, currency, a commodity, or something like this. So it's something that is now heavily used in the hedge fund industry. Some of the big hedge funds are quite savvy on that space, like Two Sigma and those guys.
You're saying on sentiment, right? If I hear correctly.
And using market emotions as well. And it's one of our job also to bring those institutional grade tools to the retail, make it simpler to use, because definitely there's something there that can bring value to any investor in the world, whether it's generating alpha or risk mitigation, definitely.
Interesting. I feel like the sentiment tools are evolving. Initially, kind of every broker out there had some little sentiment widget, but then brokers started kind of getting into detail, like only showing their most profitable traders and what the sentiment of those traders were. So it seems like your sentiment tools are evolving, and you're saying that these were more effective during the pandemic. But this could also be a short-lived trend, or do you think that, when the fundamentals and technicals return a lot stronger, will the kind of shift away from sentiment happen?
Alors, yeah, sorry to capture the audience too much, but yeah, in this case, it's a magnificent short-term tool that you can use. In normal condition, you don't use sentiment
alone, right?
Okay, that's the road to massive failure, for sure.
Right. Thank you for explaining that.
The fundamental is you do your due diligence, you do your stuff, no problem. You look at the momentum by technical analysis, and then you use sentiment as a timing tool. So in normal market condition, works that way, perfect. When the markets are a bit crazy, you have to shift slightly how you use your tools, and that's quite important.
Excellent.
Exactly.
Thank you so much.
That's that ability to dynamically shift your strategy from one method to another, right, depending upon the market environment, is really critical. What Jerome and Trading Central are doing with basically taking unstructured data and structuring it and turning it into a metric that you can actually measure and use, and add that in to complement your trading strategy, right? So this is an addition to your technical analysis. This is an addition to your fundamental analysis. It's that additional ingredient that you go, oh, as I was saying, you want to be looking at volatility tools, Bollinger Band, something like that in these volatile markets. That's really going to help you when you start putting in the sentiment data. And then if you can lay that together with seeing your trades on the chart, and you can really create that whole story, then I think, Anne and her analysis is really going to be able to see those clients who are, progressing down that path from that beginner trader to the more experienced trader.
Yeah, I think, and I think the other thing that we find really fascinating is, so we come at behavior, right? Just kind of like a parallel to sentiment is, if you are a fear-based trader, you're going to react to market very different to if you're a greed-based trader. And we see some of the really psychological metrics we have, like one of the simplest metrics we have is, how do you behave on your first trade of the day, right? And if that is statistically telling you that you have a strong strength or a weakness, right, it's almost like a proxy for a fear or a greed-based trader, right? So many successful traders, if you just took their first trade of the day, they're abysmal. They persistently lose, they have bad win rates, they have terrible risk rewards, etc., right? Because they're greed-based traders, can't wait for the market to open, right? And we saw a huge movement in some of those metrics when the volatility was higher, right? But if you have a fear-based trader who takes all day to set up his first trade, but it's really successful for him, right? That's the kind of behavior you want to know about yourself, because, you know, you can look at your first trades and go, oh my God, this is an incredible history. I could be a really successful trader. And what we say to them is, yes, you can. You've proved you can do it. Now apply that to the rest of your day, right? So it's like a personal version of the sentiment thing. It's your own emotional sentiment, really, that triggers for people. It's fascinating.
Right, sentiment on a micro level, I guess, to the individual. So on that point with fear, it's interesting you painted in that context in a positive light, I guess, because in that case, it's better for a trader to be, I guess, fearful and take the defensive approach as opposed to the greedy trader.
Yes, there's no right answer. I mean, the key thing about emotion is, as long as you understand your biases, then you can react to your biases. So, you know, if you happen to be really weak on your first trade of the day, make it small, get it over with, get on with it, right? It's not rocket science. Yes, over time you should try and deal with your issues, but similarly with somebody who's strong. So for us, we don't say this emotion's good or this one's bad, or we say, understand you suffer from this and find a way to, to work around it, right?
Right.
Just like with every signal, how do I react when I use this signal, and is it working for me? And if not, so it's all about collecting the data, analyzing the data, visualizing it, and giving it back to the traders in a way that they can see the actions.
Excellent. And on that note, with regards to signals, I mean, I know historically, you know, 15, 20 years ago when the FX markets were more, I guess, the trends lasted a lot longer. And now they're kind of, you know, faster, more efficient, more dynamic. Trends are more fleeting. I mean, maybe now with the pandemic, some trends will return. But with regard to, you know, when you have software out there that's generating the same signal across multiple brokers, or you have, you know, all these traders that are looking at the same trend line or the same indicator, do you think there's any kind of limitation on the scalability of some of these strategies? And are you seeing traders, you know, look for alternative strategies or an alternative indicator or some kind of, you know, rare chart pattern to find opportunities, as opposed to, you know, everybody jumping into the same signal at the same time, and whether that might affect execution? Or is this like not a problem and kind of a non-event because the FX markets are so liquid? And this is open to anybody.
Well, from my end, I mean, so many good points were just mentioned, but I would say that, let's say in monitoring some of my traders and some of my clients and money managers, I see that some people that at one point were very disciplined, or that had a strategy that I could identify based on where their entry points and exit points were, they've almost gone out the window. You know, I see a total lack of discipline from traders that I've known for years that are very disciplined. And despite having any signal or, you know, any system, or even using, you know, Bollinger Bands, looking at the volatility, et cetera, I think probably the biggest, let's say, common mistake that I'm seeing, which I'm not seeing, which I wasn't seeing in the past, was I'm not seeing much of an exit strategy from a lot of traders. They're just kind of getting in trades, they're holding them, and they're just waiting to the markets to jump and just to get out quickly, like almost like a scalping strategy, to a little bit longer term scalping strategy. I don't see much of an exit strategy. I'm not seeing as consistently take profits being set, stop losses being set. So with that being said, this is the more concerning aspect with everything, is strategy aside and market sentiment, fundamental analysis or technical analysis aside. It's the fact that I'm just not seeing much of a consistent exit strategy from some of the more disciplined traders that I've seen in the past. And from a beginner trading perspective, I think the exit strategy or exit plan is one of the most underrated things for the new trader to learn about. Everybody's like, when do I get in? And I'm more concerned on when I'm going to get out. And this should be in all aspects of life, not just trading. Exit strategy is very critical. So this is probably the most common thing that I'm seeing.
I think that's a great point, Nima. And I think, I've looked at this question of, the signals, you have a crowd effect, and I don't see it, right? I've looked at that throughout my career as I've been focused in technical analysis for over 30 years, right? People look at signals differently. They look at different markets. They have different time horizons. They have different execution strategies, capabilities, different risk management strategies. The markets are really deep. But this aspect of how you get in and how you get out, that changes the whole dynamic. It's exactly what Ann is studying, right? And so that's, you can have two traders take exactly the same signal and end up with radically different results, right? And then that entirely changes their market psychology and how they're going to take that next signal, right? The guy who won is going to double down the next time. The guy who lost is going to cut a position in half, right? And that's actually good risk management, right? Is if your account's growing, yes, you should be more aggressive. Actually, I'll let Ann comment on that. She knows that a lot better than I do.
Could get completely different results, but actually 100 traders would get 100 different results because the signal is such a tiny piece of it, right? And speaking of streaks, so again, traders can fall into 4 different categories, and they can have 2 strengths or 2 weaknesses. But the people who, after closing a winner, give it back, may also, after closing a loser, lose their confidence, and those type of traders have real difficulty. Particularly if they're high volume traders, if they're more scalping and doing 10 or 15 or 20 trades a day, that's not a good combination. Whereas if you're doing 3 or 4 trades, sorry, Steve, you're going to ask me something?
No, please continue.
So Eugene is exactly in agreement with myself. The same signal means something completely different to everybody. But I was just starting to talk about streaks, and so the type of trader who maybe 3 winners could be it for them. That fills them so full of this is so easy that they give it all back, right? So their weakness is 3 winners in a row, and we look at that 4th trade and we go, do you know that's returning you, it's knocking out half your profits for the year by just that habit. So that's the kind of reason. So of course those next trades are going to take those signals completely differently.
Right.
So the signal doesn't count, it's the execution, it's the risk management, it's planning your exits, good or bad, and it's measuring.
It's consistency all over the place.
Consistency.
Over days and days and weeks and months, because every time you move away from the strategy you have built over weeks with the tools that you are familiar and you are happy with, and the moment that you have a winning streak and at the moment you have a losing one, it's the exact moment where the human element come into play, and that's where you are a good trader or a bad trader. It's like, do I want to implement a new trade that will offset my my loss here, or I say, okay, you know what? I've made my day. My rules are these ones, and I don't change them. And
that's a discipline.
It's a discipline that is super difficult to follow, for sure, for any traders.
I'm sure, especially
beginners now, we are saying that if you have 5 consecutive losers, you must stop trading for the day, right? And if they choose to trade, all of their trades after that are marked as undisciplined, right? Because what we find is we grade every single trade, and it's your own plan. If they decide to change 5 to 4 or to 6, as they get more mature, they can. But what we find is that traders, if we take the trades where they stick to their plan, 80% of losing traders make money, right? So it is those moments where they lose their own discipline, right, that they lose all their money.
Those few trades could make the difference between
absolutely. most traders, if you count the number of trades that they had to eliminate to become profitable, it's really small. It's often 3 or 4% of their trades.
So that's why everyone listening, to all the traders out there and investors that are, tuned in here, discipline is key in following a strategy. And back to what Nima mentioned earlier about observing some traders who have maybe deviated from their trading strategy in the past couple of months. What are your thoughts, Anne, about like if you're trading? I think I've noticed this with some Bitcoin traders where they might be long the underlying, in a small percentage of their portfolio, but then they have another portion of their portfolio where they're day trading the asset. And, if a trade goes bad, maybe they'll just, turn it into a long-term position, which obviously is not good if you need to sell the next day or if you need the money, because then you're stuck in that trade, as opposed to, a real day trader that's in and out at the end of every day, or, if you're a swing trader. But have you noticed people who will, have like a long position in, let's say, the Euro USD, but then kind of have, a certain percentage of the rest of their portfolio where they're, going long and short the Euro, while they keep that larger, longer term directional position?
I think beginners struggle a huge amount with that because many traders see their profitability as their closed trades, right? And so they will, look at so 3 or 4 open positions, and 2 of them are making a little bit of money and 2 are losing a little bit. They're highly likely to close the 2 winners for small wins, and they're highly likely to leave the losing trades open on the hopes that they're going to return, right? And so we have invented something called disposition, which is how much time do you spend in winners compared to losers? And if it's less than 1, you're doing that. You have that behavior, right? Which means you're not giving your winners time to run, and you're not letting your losers, you're not closing out your losers quickly enough, okay? And many people do that.
Dilemma.
Yeah, so they might have a long losing position sitting there for days, and then they'll try and make some of it back on little short trades, right? And what they're doing is they're ignoring the losers and trying to focus on quick wins, and then they see some profitable trades go in, and they're looking at their realized P&L, and traders can convince themselves for a long time that they're doing okay, but they've got a couple of bad opens, right? And we're very keen that people look holistically at the whole approach, right? And you've got to look at your opens and close together, and the behavior, as much as winning streaks and losing streaks is important, it's really important if you're in one right now, and that's when you have to manage, right?
Right, absolutely. So I think we're running a little short on time, and we have some questions from the audience that I want to get to here while I still have all you guys here with me. Basically, we probably have time for a few questions, so I'm just checking the comments section here. And okay, the first question I hear is, wait, this one I think we already addressed earlier, just so happened. Okay, do you believe the US dollar will weaken from all the stimulus programs? And what about the Japanese yen and other countries that are printing money?
So my perspective is that in the long run, we get inflation, right? That there's no question that we are debasing our currencies here. I think the question, currency trading is about comparative analytics, right? It's about, which country is going to outperform the other. So that's where it's really hard to figure out, like who is going to be, where people are going to go, right? I think as we come out of this, is the dollar, still that safe haven, which is of course where people go to. I think it probably sees some downside as the markets begin to settle. But I do think there will be some really interesting trends as we see, as I said earlier, the countries come out of this with different policies, and we see different growth environments.
Excellent. Is there anyone else that wanted to add to that? I think Eugene addressed it pretty well. We could move on. The next here is, what is the best way to diversify when markets are volatile? Are successful traders using gold, crypto, and oil, along with Forex and stocks?
Well, I'll jump in. I think Ann really has the right answer there. And that is, don't trade too many things and don't trade too many sectors. They move differently, they behave differently. Yes, you need some diversification, but if you're an active trader, know your space. Don't try to cover them all. That's a ticket to, what Ann was saying. Just you're going to get lost.
Too much information, and it's better to just.
I think even just diversification actually can backfire to a certain extent, almost to what Eugene and Ann were saying at one point. So diversification is kind of a tricky word when I hear it. It makes me more nervous for the trader than concerned or happy for the trader. Diversification
is good for an investment strategy, right? It's good for a long-term strategy. It's not good for a trading strategy necessarily.
Exactly, agreed.
Especially when there's markets crashing, everything crash at the same time. So there's no safe haven on the short run. So correlation goes to one all over the place. We even see that gold was not necessarily acting as a pure refuge play at some point. So
right, initially it pulled off.
Yeah, that's why it's really important to understand these events on the chart and be able to see what the different, be able to do that cross-market analysis and show what different events are happening, because what Jerome says is dead on the money. Correlations go to 1 in these environments, and you need to be able to see that and understand that.
Excellent. I think we have time for one last question. I see here one. My friend mentioned that hedging is becoming more popular to play both sides of volatility. Are you seeing many traders using hedging in their trading? I think we kind of talked about this a little bit, but not directly hedging.
We've definitely seen with our clients a pickup in option activity, which is either a way to manage your risk or to hedge. Both are tied together. So we're definitely seeing that, and I think tools that help you understand the options market, the volatility in the options market, the skew in the options market, your payoffs, those are all critical tools. And I think that in this environment, that's something that the vendor and broker community needs to continue to invest as we are facing change in this environment, and we have to move forward and embrace that, right? This is what we see coming out of this is going to be different.
Excellent.
Yeah. The retail community is much more educated now than they were before, because there's a lot of tools available. So now hedging using options, it's not as complex as it seems before.
Right.
There are many brokers that tries to simplify even the lexicon of the options, and without using words like skew or time structure that could be scary for some people. They just say volatility, implied volatility is a measure of risk, skew a measure of downside risk or upside, time structure over the time. So it's easier. So people are hedge more easily because they understand better, because they have more.
I meant to ask, because I don't work in options so much, but how's the pricing of the premiums now with all the volatility? I mean, I would imagine the premiums are extremely high these days, or I mean, how's that going?
The premium is higher with implied volatility, of course.
Right. I also read that when the interest rates come down, that causes the call options to be more expensive, but the put options to be a little cheaper. But as Jerome mentioned, now with implied volatility so high, you're kind of overpaying a little bit for, I guess, those premiums.
Yes, because actually the implied volatility is higher than the historic volatility, I would say. So you are paying a premium. So buying calls are not necessarily the best thing to do right now. You tend to sell volatility, and the professional options trader in that space are constantly selling volatility, buying, receiving premium, and get some return. So usually,
and back to your point,
these guys make some money in down market because they are just collecting these stuff.
And to your point, now soon it's becoming easier for traders to do those sophisticated strategies, even though they could be very risky, because the brokers are making it easier to understand the terminology, whether you're doing like a net credit spread or some other bearish call type of advanced options. But I wish we had more time to discuss so many fascinating topics with you guys, and I'm sure this has been great for our listeners. So yeah, thank you. I want to thank all the speakers here and thank all of our listeners from all over the world for tuning in today. And yeah, we're going to say goodbye and wish you success in your ongoing efforts with trading and at this conference today. So thank you all.
Thank you, Steve. Thank you all. Pleasure to meet you. Have a good day.
Thank you.
Thank you.
Thanks, everyone.
Pleasure to speak with you.